Jian Chang. She's a China economist at Barclays Capital. Jan, nice to see you. First of all, these figures, CPI, certainly a little bit hotter than most economists had expected. What does it mean?
Yeah, actually, we forecast the CPI inflation to be at 6.5%. But not only the CPI inflation remained elevated, and the PPI inflation also came in at 7.5%. So I think that suggests that inflation remains a significant risk to China. But with the most recent global financial market turmoil and the expected slowdown in this external demand, and I think that clearly has complicated the picture for the Chinese policymaker in balancing the growth and inflation risks.
So, whereas you might have expected the Chinese to perhaps hike, tighten some more, as of the last 10 days, you no longer expect that?
Yeah, that's actually today's CPI inflation data should be supportive of our view of one more interest rate hike in Q3. However, if the financial turmoil persists and if there's a further contingence in the European debt crisis, and we do see the probability of one more interest rate hike is decreasing. But that being said, and we don't think the monetary policy has yet to be in the position to loosen, and we don't see any form of interest rate cut or RRR cut to be in the near term.
So what does all of this mean for China, this increased prospect of a recession in the U.S., perhaps in the global economy? What are the Chinese government really going to be worried about right now? Exports?
Yeah, I mean, clearly the most recent development in the markets and as well as the expected kind of weaker external demand has posed, I think, downside risk to our growth forecast. And by our judgment and until end July, the government has yet to perceive external risk as a major concern. But clearly, the most recent development in the past week will likely trigger a reassessment of the global economic outlook and the impact on China by the Chinese government, in our view. And yes, they would be concerned about exports, and they would be concerned about possible synchronized global slowdown, and especially if there is a vicious cycle between the markets and the economy.
Okay, let's say what you're describing pans out some more, and that's where we end up. Does China have room to maneuver? Can it stimulate itself some more growth? Will it perhaps provide some more fiscal stimulus, the government?
Yeah, I think you're quite right. This is what we've been writing in today's reports, is that I think, well, there's a limited room for policy maneuver on the monetary side, especially given inflation prints remain elevated, and also there's a significant and persistent underlying inflation pressure. But fiscal policy could play a bigger role in helping to support the economy in the second half of the year and also into the next year. China has a fiscal deficit of around 2% of GDP this year. Well, in the first half of the year, the government posted a surplus of 2 to 3%. So overall, there's room to maneuver on the fiscal policy front. And so we do expect the investment growth to slow in the second half of the year, but we think the investment growth will remain supported by public housing construction. We still have about 5 million new units to be started in the second half, and also the water conservancy project
We're almost out of time
going forward.
We're almost out of time. Just one quick question, and this is a broader one for you. Is what we're seeing on the markets emotion, or is there a rational, fundamental aspect to the selling?
I think immediately, I mean, the most recent, I think that the downgrade of the U.S. credit rating and has probably triggered a rethinking of both the fiscal sustainability in the U.S. and also the medium-term growth outlook. So I think there's both some immediate shift, bearish sentiment shift, and also there's thinking of the medium-term growth outlook.
Jian Chang, China economist, Barclays Capital Asia, thanks for being with us.